Hello everybody, this is Philip Jonas at Kalamazoo Valley Community College presenting OpenStax Principles of Economics, and today we're covering module 28.1 through 28.5, the Federal Reserve System. In this module, you will learn to describe the structure and functions of the United States Federal Reserve System, explain monetary policy in an environment of ample reserves, and understand the Fed's role in regulation, payments, and consumer protection. So let's get started talking about the Federal Reserve, or to be more precise, the Federal Reserve System. So the Federal Reserve System is the central bank of the United States, but it has a somewhat unique hybrid structure that, while it does have a central board in Washington, D.C., the actual banks conducting operations are split up into 12 branches spread throughout the United States. And then for one of the key functions that we'll spend the most talking about today, monetary policy, this Board of Governors and the 12 Federal Reserve banks come together in what we call the Federal Open Market Committee, or FOMC for short, to conduct monetary policy. But that's only one of the 5 key functions of our Federal Reserve System. The system also is tasked with maintaining the stability of the overall financial system, as well as supervising and regulating individual financial institutions. Along with that, it's responsible for a large part of payment system settlement and clearing in our country. And finally, it engages in direct community development and consumer protection as well. So let's get to know our Federal Reserve System a little bit, starting with where the authority comes from and how the members of the system are appointed to begin with. Like, when did I ever vote for the chairperson of the Board of Governors? Well, all of this started with the Federal Reserve Act, which established the system over 100 years ago. And even though you will sometimes run into perhaps a conspiracy theory that the Federal Reserve is a privately operated bank for profit, something along those lines, that's of course not true at all. Instead, it follows a relatively standard structure in the US government where members of the Board of Governors are nominated by the president, but then the Senate has to confirm these nominations. Something you might be familiar with from, for example, Supreme Court nominations, since those tend to make the news quite a bit. But of course, this is used for many other high-level appointments in our government. Now, similar to the Supreme Court, we do want our central bank to be somewhat insulated from political pressure. And as a consequence, these Board of Governors don't have lifetime terms, but they have very long terms, 14-year terms. And then out of this 7-member Board of Governors, the president also nominates one of them to be the chair and then also a vice chair. And they hold those roles within the Board of Governors for 4 years. And that can be renewed on a regular basis as well. So a lot of our time today, we want to spend talking about monetary policy, which is conducted by the Federal Open Market Committee, or FOMC for short. And that's a 12-member committee that's a hybrid of the board and certain presidents of the Federal Reserve banks. So we've got 7 members on the Board of Governors, obviously, so that's a slight majority of the Federal Open Market Committee right there. And then 5 presidents from the Federal Reserve banks also serve. One of them is always the same. That's the Federal Reserve of New York, because that's where the financial markets are, and they conduct a lot of the actual open market operations. And then the other 4 rotate with 1-year terms among our remaining presidents of the local banks. But let's first talk a little bit more about this Board of Governors. So again, 7 members, one of them is the chair, and as I'm recording this video, that will be Jerome Powell. So when you hear about the Fed in the news, whoever is that chairperson of the Board of Governors is often said to be the head of the Federal Reserve, the chair of the Federal Reserve, something along those lines, sort of a shorthand to illustrate that they are the most powerful person there. However, when it comes to this Board of Governors, each of the governors has one vote, so he's really more a first among equals, but certainly with a lot of power by virtue of, for example, talking to the public. Now, I already mentioned that each of these governors is appointed for a 14-year term, assuming it's a full appointment. But what's interesting is that it's also a one-term limit. So once your 14 years are up, that's it. Can't be nominated again. There is one way in which you can serve even longer. The 14-year terms are staggered. So the way it works is every 2 years, January 31st, the president gets to nominate for one of the 7 governor positions. That way you don't run into sort of problems where people will be strategic about when they retire, or they want to wait for a president, that they especially like, or some presidents get to appoint a lot and some presidents very few. No, it's always every 2 years, which of course means if somebody resigns, retires, something along those lines, before their 14-year term is up, we now have this vacant term that's not yet fully served out. And whoever gets nominated for that, after that's done, can do another full 14-year term. So for example, if you come in filling a Board of Governors position that has 8 years already served, so 6 years left on the clock, you can do those 6 years and another 14 for a combined 20. But then again, at the end of that, you're definitely out. And then within the Board of Governors, while you're a governor, you can be nominated to be the chair. So right here, Jerome Powell, or right now the vice chair, Philip Jefferson. And that's 4-year terms. So it's entirely possible that you don't get renominated for that, in which case you step back into being a regular Board of Governor members. It's not like that would sort of remove you from your 14-year term or anything along those lines. So let's go ahead and have a look at the Federal Reserve banks now. As I mentioned, our central bank, a little bit unique in that it's not that central, but actually a federalized system that's spread across the United States. So we've got 12 Federal Reserve districts. You can see them displayed right here. You see that they don't always break neatly along state lines. So like, for example, right here, New Mexico, cut in two. And then we have states that are not continental, or perhaps some territories of the United States. And those are grouped up with San Francisco here on the west and New York over here on the east. Interesting factoid, by the way. When we talk about checks later on today, good old physical paper checks, the number of the Federal Reserve District that the bank that the check belongs to comes from is going to appear on that check. So I'll tell you later where that shows up. The Federal Reserve banks also have their own system for how presidents get selected. And once again, there's a little bit of a hybrid system going on here, and also sometimes a little bit of a misconception again. So the Federal Reserve banks have a number of directors. They're called Class A, Class B, Class C. And the Class B and C directors are really the important ones for our purposes here. So the Class B directors represent the public from the local member bank. And the Class C directors also represent the public and get appointed from the Board of Governors, so from the top, so to speak. And only these Class B and C directors can then vote for the Reserve Bank president nomination. And whoever they nominated again has to be approved by the Board of Governors. So at the end of the day, like, the whole process is firmly in the hands of the government, as of course it should be. But what's a little bit unique about our system is that we also have these Class A directors at each of the Federal Reserve banks. Again, they're completely removed from selecting presidents. They don't get to do that. But they represent the banks that are members of that district. So these actual private for-profit banks do have a certain role at the local Federal Reserve Bank level. And, there are certain benefits to that as well, but it should be noted that that part of it is not coming out of a democratic process, but instead out of the businesses of these banks. So finally, all of this comes together into what we really want to talk about: the Federal Open Market Committee, or often affectionately referred to as the FOMC. So 12 people who conduct the nation's monetary policy. 7 of them are directly the Board of Governors, permanently, always at the table. And then we've got 5 Federal Reserve Bank presidents. One's New York. New York always gets to be at the table. And then 4 rotating one-year terms over here. And together, these 12 people ultimately decide big questions such as how many US dollars should exist and what should certain leading important interest rates be. And since the United States is the world's largest economy, it would be very fair to say that in terms of immediate economic power, these are perhaps some of the most powerful economists in the world. Let's talk a little bit about how they do their job. So, key function of the Fed number 1, monetary policy. Here's the high-level overview. The Federal Reserve has a so-called dual mandate. They are supposed to keep employment really high at full or maximum employment. So conversely, keep the unemployment rate low. And they are supposed to maintain stable prices, which is sometimes misunderstood. So stable prices here refers to an inflation target. We're not looking for 0% inflation. We're looking for 2% inflation. And perhaps even more importantly, we want that number to be reliable and predictable so that you can, plan 10, 20 years into the future and have some confidence that inflation is going to be around that 2% mark. So the way they go about this dual mandate is the Federal Open Market Committee makes decisions that affect interest rates in our country. And interest rates, of course, in turn, affect decisions that households make. Should I buy a house, buy a car? And businesses, should I engage in that new business venture, considering that changing interest rates change the value of investment spending? And the idea is that they set these interest rates to balance the dual mandate of keeping employment high while inflation at the 2% mark. So if we tie this back to our model of aggregate supply and demand, there's basically 2 standard conditions that monetary policy is very effective at dealing with. So imagine we're currently looking at an economy that's at actual full employment. So aggregate demand curve, short-run aggregate supply, long-run aggregate supply, they all intersect at one point. Inflation is on target, GDP is at potential, employment is at full employment, so we're at the natural rate of unemployment. And then a negative demand shock hits our economy. So this is, of course, the standard recession story. As our economy enters a recession, we've got inflation falling, perhaps even going negative if it's a really bad recession, and output falls below potential, meaning, of course, that the unemployment rate will go above natural. Now, we've already discussed that the government could now directly try to counter this recession by, for example, increasing government spending. But that's a slow and crude process compared to what the Federal Reserve can do. In this scenario, they can engage in what we call expansionary monetary policy, which means they will lower interest rates so that consumers buy more durable goods, build more houses, and businesses undertake more investment spending. And the idea is that this can stimulate aggregate demand enough to get us right back to full employment and the inflation target without needing big, cumbersome government spending and taxation policy. Now, this isn't always enough because there are limits to what the Federal Reserve can do. So, for example, lowering interest rates to stimulate the economy, well, you can't lower them below 0%. Like, for example, a problem we ran into with a very bad recession, 2008, 2009, financial crisis, the Great Recession. But for milder recessions, like 2001, for example, this is a great playbook. Then let's talk about the opposite possibility as well. Let's say we've got our economy ticking along again at full employment. And now for some reason there's excess aggregate demand. Our economy is overheating. So GDP goes beyond its potential, which sounds great on paper. But of course, because the short-run aggregate supply curve turns very steep here, that means that inflation goes above target, and we don't like that at all. So here, once again, the Federal Open Market Committee can put on the brakes and engage in contractionary monetary policy. And they do that by raising interest rates. So that'll make it more expensive to buy a car, more expensive to engage in business investment. The idea is we're going to put the brakes on spending, on aggregate demand, until we're back at the desirable full employment and 2% inflation level. So that's it. That's the basic playbook. If the economy is below potential, lower interest rates. If the economy is above potential, raise interest rates. Of course, the details are much trickier because there are still some lags between when you engage in your policy and when it actually affects the economy. Many people estimate maybe 6 months or so. And you also have to figure out the right size of these steps, right? But still, it's elegant. I would go so far as to say this is our primary and preferred method to try to stabilize our economy outside of course, automatic stabilizers. However, there has been a rather significant change in how we go about influencing these interest rates. So prior to the Great Recession, 2008, 2009, the Federal Reserve was operating under a system that's referred to as a limited reserves regime. So what this refers to is the reserves of our banks. If you think about how a bank operates, it attracts deposits, checking accounts, savings accounts, things like that. And of course, the way the bank makes its money is it doesn't keep all of those deposits, but instead it turns around and loans them out, perhaps for a mortgage so that somebody can build a house. So not all of the deposits at a bank, the bank holds on to. What it does hold on to are referred to as the reserves of that bank. And typically these reserves are deposited in accounts that banks have at the Federal Reserve. So you can think of the Federal Reserve as sort of the bank for banks. That's where banks have their bank accounts. So prior to the Great Recession, these reserves were limited in the sense that banks, of course, want to hold a certain amount of money in reserve because somebody might show up and want their money back. You better have that money on hand. And the Federal Reserve also had some regulations, some minimums of how much you had to keep in reserve. But there wasn't a huge amount of extra money floating around that the banks could keep in reserve. So this affected how easy it was for them to make loans, which of course means it affected interest rates. So what the Federal Reserve would do is, if they wanted to bring interest rates down a little bit, make it easier for banks to make loans, they would add money to the banking system through something called open market operations. They would basically go out there and buy bonds such as US Treasury bonds on the open bond market. And when they paid for those bonds, this is the special power of a central bank, they would pay for those bonds by creating brand new money. This put new money in circulation, made it a little bit easier for banks to have reserves, lowered interest rates a little bit. And vice versa, if the Federal Reserve was trying to put on the brakes, they could take some of those securities they have in their vault, so to speak. They would sell them on the open market, and whatever money they received in return, they would just delete out of their system. Because again, that's the special power of a central bank. It can create and delete money out of its own bank account. So they did all this while keeping an eye on interest rates, but especially one interest rate. Most central banks like to have sort of a target interest rate that they use to communicate policy decisions, and the Federal Reserve's preferred interest rates, the so-called federal funds rate, or FFR for short, which is the interest rate that banks charge each other. So it's not that the Federal Reserve directly controls that rate, but if banks were being a little too low interest, making loans to each other, the Fed would remove a little money from the system so their rate came up. If banks were charging each other a little too much for the Fed's taste, well, then the Federal Reserve could add a little money to the system, bring that rate down. That was the old system, the so-called limited reserves regime, until the Great Recession. After the Great Recession, the Federal Reserve switched to a system called ample reserves. So, very different approach here. The Federal Reserve now actually has lots of money available to our economy, and banks find it very easy to have reserves on hand in case somebody wants to withdraw their funds. You know, they've got lots of extra cushion there. But of course, that leads to the question, well, how do you achieve an interest rate target if banks have all this extra money they could be lending out? And it's not just the banks, it's other financial institutions as well. So the new system is that the Federal Reserve directly controls certain interest rates that in turn affect the federal funds rate. And the big ones here is that the Federal Reserve pays interest on the bank accounts that the banks have with it. It didn't used to. It used to be if you had reserves at the Fed, there was just a 0% account, if you will. Now the Federal Reserve pays interest on these reserve balances. And of course, no bank is going to make a loan at an interest rate lower than what they can get just by depositing their money super safe with the Federal Reserve. And then something very similar is available to financial institutions that aren't banks. So these financial institutions that aren't banks, they don't receive interest on reserve balances because they don't have reserve balances with the Fed. But they can engage in something with a very complicated title: overnight reverse repurchase agreements. Overnight reverse repurchase agreements. Perhaps sometimes even more confusingly referred to as overnight reverse repos. So what this is basically the Federal Reserve says you can buy securities from us, such as treasury bonds, for one night. And then the following morning, we will buy them back from you at an agreed upon price. But we'll give you a tiny bit more money than you paid us, which effectively represents an interest rate. So they don't quite have a reserve account with the Fed, but they can kind of do the same thing. They can go to the Federal Reserve's trading desk, say, hey, let me buy this treasury bond. I'll sell it back to you tomorrow at the following price. The additional price at which I sell it back to you tomorrow, that represents me receiving some interest from giving you some money overnight. And again, this prevents these financial institutions, well, it doesn't prevent them, but it incentivizes these financial institutions to not make loans at an interest rate lower than what the Fed will give them super safe. Now, finally, the Federal Reserve also has a tool available to make sure that interest rates don't go too high. If there is a concern that the borrowing cost for banks becomes too high, the Federal Reserve can also make loans to the banks. So when the banks have deposits with the Fed, that's interest on reserve balances. When the banks borrow from the Fed, this doesn't happen a whole lot, but it does happen. It's referred to as the discount rate. And of course, no bank will pay a higher interest rate than what it could just borrow from directly for the Fed. So you can perhaps already see these interest rates that the Fed now directly offers. They put a floor and a ceiling on the interest rate that could exist for the federal funds rate. And of course, the federal funds rate, the rate at which banks can borrow money and other financial institutions such as government agencies, in turn affects many other interest rates in our economy. The federal funds rate affects the prime rates, which is what the interest rate banks give their best customers. It affects even very long interest rates, like mortgage rates, for example. I mean, federal funds rates for overnight loans, mortgage rates might be for 15, 30-year loans. Still, they are linked up because what a bank pays for its credit affects what it charges to lend to others. Now, that's not to say open market operations of the permanent type have disappeared. They still exist to control how much money the Federal Reserve makes available to the banking system to begin with. So basically they control how many dollars are in existence, but they are no longer used to directly control interest rates in our economy. So let's go ahead and have a look at this change in regime here with our Great Recession 2008-2009. So what you're seeing here is the amount of reserves that banks and other depository institutions, such as credit unions, for example, had deposited with the Fed. And you can tell prior to the Great Recession, this number was, well, it almost looks like zero here, but this was actually billions of dollars they had deposited. Number one, because somebody might show up and want their deposits back. And number two, the Fed actually required banks to have at least 10% of many types of deposits on reserve every single night as a regulatory requirement. But then notice during the Great Recession, our banking system, well, let's face it, it almost fell apart, right? The Federal Reserve completely changed tacks and basically switched to a system of, hey, we don't want our banks to have limited reserves. We want them to have lots of money in reserve. So it conducted a large amount of open market operations, bought lots and lots of government bonds and such, and just really increased the number of extra dollars in circulation. But then it used interest rates in order to make sure all these dollars wouldn't just go flying crazy through our economy and drive up inflation too much, but rather they would stay locked up in the reserve accounts of the banks as sort of a, safety cushion. This is probably the best way of referring to it. You can again see another crisis here with our COVID pandemic, where the Federal Reserve once again added some extra reserves into the system. So the real control now comes through a whole number of interest rates with a large number of acronyms that, you should know about, but that can really add confusion to the system. So let's just run through them. From the top, the Fed pays interest to financial institutions. If you are a bank or another type of depository institution such as a credit union, you directly have an account with the Fed, a reserve balance account. The Fed pays you interest on those reserve balances, IORBs, interest on reserve balances. Banks will not make loans at a percentage lower than that IORB because the IORB is guaranteed with the Fed. Why would you take anything less? If you are a financial institution that isn't a bank, like let's say, for example, you're Fannie Mae, which is a big government-sponsored entity that is involved in the US mortgage market, let's not go into details. You also have the option of receiving interest from the Fed, but through a slightly more complicated process. Rather than receiving it in a reserve account, you can instead every day go to the trading desk of the Fed. You can buy treasuries from that trading desk, which means you're giving the Fed your money with an agreement that tomorrow the Fed will buy the treasury back from you, giving you your money back plus a little bit of interest. This is referred to as overnight reverse repurchase agreements, or ON space RRP. This leads to non-bank financial institutions not lending anybody money at less than the ON RRP they can get, because again, why would they? That's a guaranteed rate of interest right there. Now finally, the Federal Reserve can also lend money to banks through what's called the discount window. That puts a cap on how much banks will pay to borrow, because they can always go to the Fed, borrow at the discount window using an interest rate called the discount rate. And no bank should pay more than that when they can just borrow from the Fed. Open market operations, or OMOs, still hang out in the middle, but the Fed is more using those to manage how much money exists to begin with. Technically, these overnight reverse repurchase agreements are also open market operations because they are happening through the Fed's trading desk, but they are temporary. They are just overnight. So typically when you say OMOs, you're referring to the permanent changing of how much money exists. And then finally, the point of engaging in all of this is for the Fed to target another interest rate, the FFR, the federal funds rate, that the Federal Reserve doesn't directly control, because it's the interest rate that financial institutions such as banks charge each other. But by manipulating the interest rates that the Fed directly controls and sets, it can achieve a very effective target for this federal funds rate that will keep it boxed in. Let me show you what that looks like. So for starters, we're going to look at the longer time frame here of our new ample reserves monetary policy regime, which can be a little bit harder to see over the longer time frame. So I'll zoom in for you on the next slide. So the target for the Federal Reserve here, its preferred interest rate target, and one day they might switch it, but they've been very happy with it for a long time, is the federal funds rate, here in yellow. That's what banks are charging each other. Now, the Federal Reserve can box that in a little bit. Number one, at the low end, by offering interest to non-banks through the overnight reverse repurchase agreements. So that's our dark green line here. Non-financial institutions, financial institutions that are non-banks, can receive that much guaranteed from the Fed. So if a financial institution wants to borrow from a non-bank, it's going to have to offer a little bit more. So you'll see that yellow line always be above the dark green line, because the people who've got the money from the dark green line, our non-bank financial institutions, why would they ever take that deal? You can go to the Fed instead. And then we have the banks, and the banks have all these ample reserves, right? So the banks with all these ample reserves, they are the second line, the lighter green line. They receive a higher rate of interest from the Fed, interest on reserve balances, than what the Fed offers as overnight reverse repurchase agreements. So as long as our non-bank financial institutions have enough extra money available to satisfy everybody who wants to borrow, our yellow line, the overnight lending rate between our financial institutions, is going to be greater than what the non-bank financial institutions can get at the Fed, dark green line. But it's not quite going to touch the light green line, what the actual banks can get at the Fed. So all those ample reserves of the banks, they stay locked up at the Fed because the banks get a better deal with the Fed than they could lending out that money on the open market. However, should we reach a point where demand for borrowing is really high, like right here, for example, 2019, 2020, it is possible that the interest rate on overnight financial institution lending goes high enough that it actually pays more than what the banks can get by depositing in their reserve accounts at the Fed. And that's going to start drawing on some of those ample reserves then, where the banks jump in and start making loans as well. So that's by design, that's okay. But the real hard cap is the red line. That's the discount window. Here's what the Fed charges the banks if the banks want to borrow instead of deposit. So light green line, that's what a bank gets if it deposits with the Fed. Red line, here's what the bank has to pay if it wants to borrow from the Fed. And of course, never will a bank end up paying a higher interest than what it could borrow from the Fed for. But you can see like that yellow line, it really doesn't come close to touching our red line in our modern ample reserve framework. Now you can see a little bit of leftover here during the financial crisis when the new system just got implemented. Interest rates between banks actually spiked way up, even higher than that discount window. That basically meant banks weren't lending to each other anymore. And the Federal Reserve had to jump in and start making a bunch of direct loans. But that was the financial crisis. And again, that was sort of the kickoff to let's move to a system of ample reserves so that that doesn't happen again. So let's zoom in a little bit just over the last year so that we can see these couple of lines interacting with each other just slightly more clearly. Dark green is what the non-bank financial institutions can get at the Fed by doing overnight reverse repurchase agreements. Yellow line is the target for the federal funds rate that the Fed's trying to achieve. And then light green line is usually higher than the target, not guaranteed, but usually higher. Here's what banks get paid by the Federal Reserve. And then the real hard cap, red line, here's what banks would have to pay if they were to borrow from the Federal Reserve. So once again, yellow line is the target, not directly controlled, but Federal Reserve does directly control dark green, light green, and red. And you can see they can just use that to box it right in, like some Tron light cycles or something like that. That yellow line is not going to escape red or dark green, and it'll typically be below light green. So this is how modern monetary policy works. So now let's put the whole picture up as opposed to the simplified picture. And I'll use the example of so-called expansionary monetary policy. So this is if the Federal Reserve is trying to stimulate the economy to give us more aggregate demand. And you can, of course, sort of imagine all of this in reverse for contractionary monetary policy. So Federal Open Market Committee decides we need some more aggregate demand. So the goal is going to be we want those interest rates to go down. So there's two things they do here. Number one, it directly lowers the interest rate it pays banks. That'll make banks more eager to lend out money. And number two, it goes to its trading desk and says, hey, if we've got some non-bank financial institutions trying to make a deal with us, start offering worse rates, lower rates on overnight reverse repurchase agreements. Somebody shows up with some cash, wants to buy a treasury, sell it back to us the next day, make a little interest in the process. We're not going to give them as much money as we used to. So now the non-bank financial institutions also become more eager to lend out. So the banks don't get as good a deal with the Fed. The non-banks don't get as good a deal with the Fed. That means interest rates start falling in our economy. Now individuals and businesses go, all right, we can borrow money for cheaper. Let's go buy a car. Let's go open another location for our business. And that's where the additional aggregate demand comes in. And then vice versa, if we're trying to put the brakes on the economy, get the interest rates up, take money away from possibilities for, financing business expansion or consumer purchases, and that'll slow things down. And that is monetary policy, which is our primary focus on the Federal Reserve system. But it's not the only thing the Federal Reserve does. So let's go ahead and talk a little bit about the other key functions as well. So of course, financial system stability. It's not just through interest rates that the Federal Reserve tries to keep the system from falling apart during a crisis. So the sorts of things that can go wrong when it comes to a financial system fall into a couple of different buckets, and the Federal Reserve monitors all of them. So number one, we can have asset prices. You've probably heard of this using the term bubbles, the idea that asset prices can get away from the underlying value of a financial asset. And then, of course, if that bubble collapses, that can be a sudden shock to the economy. So they try to keep a look on asset prices, keep a lookout for bubbles, see if there's sort of excessive risk-taking going on as well. Number two, leverage. So that's how much a banking system uses, not just a banking system, a financial system uses borrowed money as opposed to its own investors' money to make financial deals. If lots of financial deals get made using borrowed money, then if some deals go bad, it can very quickly destabilize these financial companies because they are no longer able to repay the loans they themselves took. And we often talk about banks when it comes to the financial system, but it should be pointed out that insurance companies and hedge funds behave in a very similar way to banks when it comes to this type of leverage risk. So the Federal Reserve monitors that across the board. Next, we have the funding systems in our economy. So one of the functions that banks fulfill is that they allow funding for example, businesses. Like let's say you have a business where revenue comes in big irregular chunks, but your employees expect to get paid every 2 weeks. You might, for example, have a line of credit with a bank where you can make your payroll every 2 weeks while you wait for a big chunk of revenue to come in. And it's not just banks that serve these purposes. There are also other types of funds, such as money market funds and exchange traded funds, that provide liquidity to our financial system. If these funding channels become available, an otherwise sound business might go under because it can't manage its cash flow. So the Federal Reserve keeps an eye on those funding channels. And finally, of course, there can be plain old overborrowing by households and businesses. No big financial engineering required. If households and businesses are deeply in debt, and then you have some type of economic bad conditions kicking in, it can really amplify the impact of adverse economic conditions because so many people and businesses will go bankrupt so quickly, which in turn will affect other consumers and businesses. Now, the Federal Reserve keeps an eye on all of these, and definitely financial system security and stability is one of its key functions, but I'd be remiss to not point out it's not just the Federal Reserve that keeps an eye on our financial system. Here is a big chart of what's called the Financial Stability Oversight Council of the United States, which, number one, is a council that itself keeps an eye on the stability of our financial system. But you can also look at all the members of this council. I'll let you read those at your own leisure here. All of which represent other areas of our government that keep an eye on financial system stability. Anything from, for example, we've got our insurance commissioners down to, for example, our housing agency, right? So Federal Reserve, really big, really important, not the only entity that keeps an eye on the system as a whole. And in addition to keeping an eye on the system, the Federal Reserve, of course, also regulates individual financial institutions. So in general, when we say regulate here, of course, it doesn't mean that the Federal Reserve just sort of gets to decide what laws banks and such have to follow, right? Like it still follows the standard regulatory process where the laws themselves are made by Congress. But then the Federal Reserve is one of those regulatory agencies, like, for example, the Environmental Protection Agency or the Federal Trade Commission or something like that, that takes laws and then, after inviting comment from affected individuals and institutions and so on and so forth, implements these laws as regulations. Because laws are rarely complete enough to go into the finer details, but instead leave that up to the regulatory bodies. But once again, let me emphasize, ultimately Congress is in charge. So if the Federal Reserve Board makes a regulation out of a law where Congress looks at that and says that's not at all what we want, they can go back and of course change the law and overrule the Federal Reserve without a problem. So within the context of these regulations, the Federal Reserve then goes into supervisor mode. It's got the 12 individual Federal Reserve banks. Every bank is a member within one of those 12, who on hand have a whole bunch of so-called Federal Reserve examiners. And they then go out to the regulated institutions and look at the books and the practices and the policies and so on and so forth and make sure everybody is playing by the rules. So this is plain old regulation and supervision. But then, of course, during the Great Recession, we really noticed that certain large financial institutions might be so systemically important that we're not entirely sure if we can just let them fail through a regular bankruptcy process if a financial crisis takes place. Which has a flip side to it. If an institution perhaps knows or suspects that it can't fail during a financial crisis, it might not behave as carefully as it should because it might count on being saved. So welcome to an extra special level of regulation if you are a so-called large institution. So here we've got our LISCC, which has a whole extra layer of things that we're going to look at when it comes to this financial institutions. You're going to get your own supervisory team that keeps an eye on you. They're going to have a look at how well capitalized you are. Capitalization is basically the opposite of leverage, how much of your own money you have available to absorb losses. How easily you can raise cash if you have liquidity problems. And if perhaps even those requirements aren't enough and your institution falls apart, you must have a pre-planned so-called living will for how your institution is going to go away without taking the rest of the financial system with it. Along with some governance parameters to make sure everybody's playing by good incentives. And finally, an analysis program that's keeping an eye out for emerging risks. So there's our large institution supervision. And that brings us to the payment and settlement system. This is one of my personal favorites because the Federal Reserve doesn't just conduct monetary policy, it's also intimately involved with how we pay each other on multiple levels. So number one, plain old cash. You might have noticed it says Federal Reserve notes on our money because the Federal Reserve is responsible for supplying us with an appropriate amount of those notes, of those, physical dollars to conduct business. But of course, more and more of our transactions aren't being done in regular cash form anymore. So what we also have are checks. So those also are starting to get a little bit more out of fashion. But there are, of course, ways in which you can give somebody a payment directly out of your bank account without using cash. Then we have electronic transfers that are called automated clearinghouse. So these are most of the electronic transfers you might be familiar with. So for example, if you use a bill pay mechanism, or like a draft to pay your utility bill or your rent, something like that. If your employer directly puts your paycheck into your bank account and it's not actually a physical paycheck, that's probably conducted through an automated clearinghouse. And it's not just the Fed who does it. The Fed operates a really big one. There's also a private one in the United States. So there's actually a bit of a choice in these automated clearinghouses. And then finally, if you have really large amounts of money you have to move around, or even certain types of government securities, you want an extra sort of guaranteed system that the money is going to arrive. No bounced, transfers if you're trying to make a down payment on a house, for example. And they have to arrive more or less fast, like within the same day. And these are wire transfers, and they are operated through the Federal Reserve's FedWire system for either funds or certain types of securities can be sent through the FedWire system as well. So let's just look at a couple of those. I mean, cash. We all sort of understand cash, right? But the Federal Reserve, of course, since these are physical pieces of kind of sort of paper that represent actual money in our economy, works with the Secret Service and the Bureau of Printing and Engraving to try to make sure that we don't have too much counterfeit money running around in the United States. So, the longer you've been around, the more you have noticed that on a regular basis, our Federal Reserve notes get a little bit fancier looking as more and more anti-fraud mechanisms are introduced in these bills. So nowadays, Benjamin Franklin here is starting to be quite colorful, with color shifting ink, a watermark, a 3D security ribbon, and the good old-fashioned security thread in there as well, with the little numbers in it that represent the value of that Federal Reserve note. Interesting fact, by the way, the US dollar cash is so well regarded around the world that it is estimated that there are maybe twice as many $100 bills in circulation outside of the United States than inside the United States, where it's actually the official currency. So isn't that an interesting one? Then we get to the paper checks. I don't know how familiar you are with these, right? They're starting to become less popular again. But a check, sort of a very interesting beast. You're giving somebody a piece of paper that effectively allows them to withdraw money from your bank account. So in a really old school way, you could go to the bank of the person who gave you the check and get your money directly. But of course, nowadays, the Federal Reserve makes a check clearing system available to banks. So instead, you can very conveniently take the check to your own bank, and then your bank will take that check to the other bank and get your money from the other bank. Only, of course, the Federal Reserve has since completely made that system electronic, so the bank doesn't even have to get the physical check to the other bank where it's taking the money from anymore. It can just sort of send them a picture, an electronic record, which means you don't have to even bring the physical check to your bank anymore. You can just take a picture with your smartphone these days, right? Send it to your bank gets that from the other bank, and there we go. But what's neat to point out here about checks is that even though they're becoming less and less popular, they still represent the underlying idea of how our bank accounts work. Because if you look at the bottom of a check, there are two important numbers here, a so-called routing number and an account number. So the account number is, of course, the number that you as a account holder have with the bank. So that's something the bank makes up, if you will. But the routing number is the address of your bank within the Federal Reserve System. So that's how the Federal Reserve clears the checks in between the different banks. And fun fact, the first two digits of that routing number here represent which of the 12 Federal Reserve districts this bank is in. So for example, we're looking at a routing number here that starts with 12. So that'll be District 12. Now, look at your own checks, if you have any, and you'll see what district you're in. So for example, if you're Michigan, that will be 07. Or if you see a 27, and you might be like, wait a second, we don't have 27 Federal Reserve districts. Well, in that case, you must be with a credit union. For historical reasons, the credit unions use a slightly different encoding for the first two digits. They basically add the number 20. So if you're in District 7, it's 27 instead of 7 for a credit union. Or right here, if you're in District 12, that would be 32 instead of 12 for a credit union. So those are our currency and check transactions. And now let's get to the electronic stuff. So here we are directly clearing transactions between two bank accounts. And it can go in either direction. So you can put money into somebody else's account. That's referred to as a credit transfer. So that, for example, happens if you get your paycheck deposited into your bank account. That's a crediting of your bank account, or maybe a government benefit. But other way around, you can also authorize debits against your account. So that's when money gets taken out. For example, you might have your electricity bill set to automatically debit from your account. So these ACH transactions, they're very convenient because you're sort of cutting out a lot of, there has to be a paper check, you got to write it, and you got to mail it to somebody. That's slow, stuff can go wrong there. And cash is even worse, right? Like, because of the whole security risk. If you lose the cash, it's a real problem that can happen, or cash can get damaged and things like that. Very inconvenient. So ACH, certainly a big convenience step up, and it's become more and more common to automate transactions in this fashion. But there is something even better right around the corner. I'll tell you about it in just a second. So let's have a look at what these non-cash payments look like for the United States. So over here on the left, we have the annual dollar value that's happening through electronic payments. You can see by far the biggest number are the wire transfers, which might surprise you because how often do you or I conduct a wire transfer, right? But the big transactions are wire transfers. Business to business, bank to bank, or, like if you're buying a house, something like that. That's why you're seeing such a huge number here. And you can see ACH becoming much more important than checks. Now, of course, we also have some electronic payments through the private sector. This is not directly the Fed doing it. If you have a debit card, for example, a payments network such as Visa or MasterCard might resolve the transaction for you. And then credit card, of course, one more step involved. You swipe that card. It's not really you paying the merchant where you're buying something. It's actually your credit card company paying that merchant. And then you now have a credit with them and they are going to get that back at the end of the month. But again, that's a private system. So that's the value of the transactions. But if we look at the amount, the counts of the transactions, the number of payments that happened through them, we notice the pyramid is sort of flipped. Wire transfers are a relatively tiny amount of transactions compared to the other ones, they're just really big in value, then once again, we've got ACH becoming more and more important here. So it's now overtaken checks both in value and in number of transactions. Check certainly a declining form of payment. And then, of course, just a ton of day-to-day transactions in our country, credit cards and debit cards. Debit cards swiped almost twice as often as credit cards. I was a little bit surprised to read that myself, but I guess some people really like their debit cards, so go for it. Now that is the current picture of what the electronic payments look like in our country. But there might be some exciting new stuff right around the corner as well that I want to tell you about as well. The first one is called FedNow. As of the recording of this video, it just launched last year with an initial set of member institutions in 2023. But it's a brand new payment network that's separate from ACH. So ACH is very nice, but it's been around for decades, and even with all its reforms, is kind of slow. It's, if you're lucky, same day, but maybe more of a next day thing. FedNow is a new payment system sort of built using modern electronic communication tools that is instant. You know, hit the button on the phone, other person has got the funds in their account now, or maybe a second or 2 seconds later. Now, you've probably not yet had an opportunity to use it. If you have, I'd love to hear from you, because like my credit union doesn't support it yet, but I'm looking forward to it. But over 600 financial institutions have already signed up, and I think this thing is gonna keep growing. So basically the idea is it could eventually, these things take time, it could eventually sort of overtake ACH, sort of how ACH has overtaken checks, where all of our bills and paychecks and so on and so forth are coming through this FedNow system because it's faster. But it's also so fast, you could really start to see this used for individual to individual transactions. You know, right now, if I want to pay you for something, like we went to dinner, we didn't want to split the check because we want to be respectful to the waiter. So we paid with one check, and then afterwards we're trying to split this bill 50-50. It's a little inconvenient right now, right? Like either one of us has to have some cash on them to pay the other person. And I don't know about you, I don't like to carry cash anymore. It's just so annoying. Or now we're like messing around with some private sector apps, right? Like we're taking out our Venmo or Zelle or Apple Cash or something like that, sending each other money, but we got to be compatible. And, you know, it's not usually directly bank account to bank account, but maybe there's an intermediate balance involved, right? And with FedNow, we could envision a future where we're trying to settle a balance. We just both take out our phones. I enter your bank info, I send you the money, it's on your phone right then and there, you can verify you've been paid, and we're done. So yeah, very, very exciting future news here. I certainly have high hopes for the system. And then we've got another thing that's not so much around the corner, but talk has begun. I don't want to pretend to even make a forecast that this is going to become a thing, but maybe one day? And it's referred to, somewhat confusingly, as a central bank digital coin, which is a very hip name, but it's referring to a relatively simple concept. Right now, certain entities can have accounts with the Fed. Banks have their reserve accounts with the Fed, and they actually get paid interest on those as well. And then government agencies can also have accounts with the Fed, but they don't get interest on those, right? That's why we've got those overnight reverse repurchase agreements, to do a little callback to that. A central bank digital coin is the idea what if individuals and businesses like you and me could also have accounts directly at the Federal Reserve? So right now, the only way in which we can directly hold money issued by the Federal Reserve is if we have a Federal Reserve note, actual currency. If we want to have electronic money, we are sort of forced to go through a bank or a credit union. We have to have an account with them. We can't have actual direct Federal Reserve notes in electronic form. Central bank digital coin, what if we can have a Fed account directly? So that would, of course, be 100% safe in the sort of bank run sense. A bank might go under. Of course, deposits are insured to a very generous amount, but a bank might go under. There's some inconvenience with that. Federal Reserve can't go under because they create the money to begin with. And it might also make transfers between Federal Reserve bank accounts very fast. Although with Fed now, maybe that doesn't matter as much anymore. Anyway, it's a thing that could happen. We'll see. Maybe it's starting to be talked about. For now, I'd keep my eye on Fed now instead. I think that's the current very interesting and hot thing that we can all looking forward to getting slightly better banking experiences out of. So that's payments and settlements. And once again, I think that's a pretty exciting part of what the Fed does. But let's not overlook key function number 5. The Federal Reserve also, believe it or not, engages in some direct community development and consumer protection. So hopefully, not something you'll ever have to take advantage of, although maybe the community development is some interesting thing that can happen in your area. So let's talk about that one first real quick. We've got the 12 Federal Reserve districts, and each of them has a main Federal Reserve bank in it. But in order to be a little bit closer to the city, the districts also have additional branches here displayed as little circles. So for example, District 7, we've got the bank in Chicago, but a branch in Detroit. And those branches help with community outreach. So they inform the public, they get feedback from businesses and individuals about how things are going in their area. They try to learn about what sort of challenges financial system users in our country might encounter, especially the ones that sort of don't have access as much to make their concerns heard through regular channels, especially sort of if you're on the lower income side. This is more the eyes on the ground situation, the Federal Reserve branches. And they try to engage in some community development as well to try to make financial services more accessible to the public. And then, of course, the Federal Reserve is a regulator of individual banks. So if banks behave in a naughty way, the Federal Reserve also provides direct consumer help. Now, this is not at the level of like, a clerk was rude to me. None of that. We're going to write a regular email here to the bank manager and say, hey, your clerk was rude to me. But if we have something serious going on, like a discriminatory practice or something like that, we've got website, we've got phone, we got fax. Can't forget the fax. And you can actually reach out to the Federal Reserve directly for consumer help. Check out the website, federalreserveconsumerhelp.gov. It's the real deal. And it's where some of the Federal Reserve's work gets done. And that's what having those districts is all about, so that there is local help available. So that concludes our discussion of the Federal Reserve System. I hope you enjoyed it. And at this point, I hope you're in a position where you can describe the structure and functions of the US Federal Reserve System, explain monetary policy in our modern environment of ample reserves, and understand the Fed's role in bank regulation, payments, and consumer protection. I will see you next time.